A $47 billion private valuation vanished in mere weeks, exposing a mathematically fatal flaw. How did the smartest minds in finance pour $10 billion into a company doomed to fail? When a $47 billion private market illusion crashes into public market reality, everyone pays. The reality check began on August 14, 2019, when WeWork filed its prospectus, revealing a staggering $1.61 billion net loss. Generating a $1.82 billion annual revenue required swallowing that loss. How did profitability escape a company simply subleasing desks? Grasp this, and you will read financial reports entirely differently. Backed by that $47 billion private valuation, the mainstream narrative crowned WeWork a tech darling. Looking at the balance sheet, WeWork held $47 billion in lease obligations averaging 15-year term lengths, while members only committed $4 billion in future revenues. The lesson here is that holding a 15-year lease while selling month-to-month memberships is a structural trap. This is something you can easily check yourself. For everyday people trying to understand businesses, free coffee cannot fix terrible unit economics. Forcing a high-margin valuation onto a capital-intensive real estate company is a fundamental mispricing of risk. To grasp why a $47 billion empire failed, we must examine the gap between venture capital's storytelling and the cold math of a $1.82 billion revenue stream. The public market recognized the absurdity, noting comparable competitor IWG held just a $3 billion public valuation. Why was WeWork priced 15 times higher despite being less efficient? Visionary founder Adam Neumann sold a utopian vision, securing $10 billion in funding from SoftBank to fuel geographic expansion, peaking at an 850 location count globally. Applying a software scaling playbook to physical office space requires devastating capital expenditure. We saw this with SoftBank's backing of Uber, suffering a $1.8 billion cash burn in 2018. When physical growth stalled, SoftBank was forced to take a devastating $9.2 billion write-down on WeWork. In plain terms, injecting $10 billion in funding without operational discipline rapidly accelerates business destruction. The illusion of infinite money blinded investors to the reality of a $3 billion commercial real estate sector. This brings us to the severe governance red flags accelerating the corporate downfall. Before the initial public offering attempt, Neumann quietly executed a $700 million insider stock liquidation. Why cash out $700 million while selling the public a hyper-growth story? Defenders argued his $5.9 million trademark fee for the word was just eccentric branding. This simple rule is incredibly powerful. Always watch what insiders do with their money. As the empire crumbled, Neumann was forced out with an astonishing $1.7 billion severance package, while executing 2,400 employee layoffs to cut costs. Later on, everyday people who bought into the subsequent alternative investment vehicle suffered a catastrophic 99.2% shareholder value destruction. For anyone learning how markets work, visionary leadership without strict governance guardrails is a massive hazard. It transfers wealth from the unsuspecting public directly to insiders holding a $1.7 billion parachute. Even after a $9.5 billion rescue package from SoftBank, an external market shift sealed their fate. The shift to remote work pushed the major city office vacancy rate to a record 20%. How does a company survive when 20% of commercial space sits empty? You might naturally think a massive footprint would offer resilience during market volatility. But with physical occupancy stalling and the 2019 federal funds rate of 1.5% surging, the math broke down completely, reaching a 2024 federal funds rate of 5.5%, increasing debt service costs crushed them. WeWork filed for Chapter 11 bankruptcy, buried under $18.65 billion in total debt. This failure left behind exactly $100 million in unpaid rent that directly triggered local landlord foreclosures. This is a sprawling domino effect stretching across a $100 million blast radius. When an $18.65 billion bankruptcy hits, it introduces severe systemic vulnerabilities into traditional asset classes. It damages local economies, commercial landlords, and municipal tax bases. The only way out was to brutally sever the very leases that fueled its initial $47 billion rise. Emerging from bankruptcy under Yardi systems, the company secured $12 billion in future rent savings. Can this leaner operator achieve true financial sustainability after shedding $12 billion in liabilities? The media assumes the WeWork brand is permanently toxic. Surprisingly, by abandoning grandiose storytelling, the newly restructured enterprise achieved a break-even earnings before interest, taxes, depreciation, and amortization margin in the fourth quarter of 2024. This margin simply measures a company's operating profit as a percentage of its revenue. Operating a drastically reduced 600 location count, they shifted focus toward high-margin franchising models and successfully launched new private office pods in high-traffic airports. What this means for the broader economy is that aggressive financial restructuring can save a fundamentally sound infrastructure brand, but only if legacy liabilities are forcibly removed. The ultimate indicator of survival now is whether they can sustainably push past their current 77% occupancy rate amid stubbornly rising global operational costs. Returning to our initial question of how a $47 billion illusion was shattered overnight, the answer lies in the unforgiving divide between private market narratives and public market realities. The rise and fall of WeWork is a brilliant masterclass in the profound dangers of the duration mismatch trap. Selling short-term flexible revenues while holding rigid 15-year liabilities is a fundamentally fatal flaw in absolutely any economic environment. Therefore, as the historical era of 0% interest rate capital firmly ends, I predict we will see a relentless, unprecedented wave of private market unicorns stripped down for parts. This will prove once and for all that financial gravity always catches up to companies trying to disguise concrete and drywall as software. But I want to hear your take. Do you think WeWork can survive this restructuring, or is the $47 billion brand forever ruined? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.